At roughly $10 billion in assets under management, BlackRock's silver ETF has crossed a threshold that fundamentally changes how the silver market functions. In most global markets, that amount of capital would be considered modest, almost routine. In silver, it represents a structural shock. The reason is not sentiment, speculation, or short-term trading behavior, but a mismatch between the scale of institutional capital and the physical limits of the commodity it targets. Silver is often perceived as liquid because it trades continuously in futures markets, with large daily volumes and tight spreads. This perception, however, is largely shaped by paper activity rather than physical reality. Beneath the surface of financial trading sits a much smaller and more rigid physical market, one that was designed to serve manufacturers, refiners, and governments rather than long-duration institutional investment vehicles. A physically backed ETF does not merely track the price of silver. It requires the continuous acquisition of real metal, which is then placed into custodial storage and effectively removed from circulation. As long as these funds remain small, their impact on the underlying market is limited. Once they scale into the billions, that impact becomes unavoidable. At that point, the ETF is no longer a passive observer of the market. It becomes a direct participant in the competition for physical supply. This is where the mechanics of silver begin to matter. Unlike gold, silver is not primarily a monetary reserve asset that sits idle in vaults waiting to be revalued. It is a consumable industrial input. Large portions of annual silver production are used in electronics, solar panels, medical equipment, electrical infrastructure, data centers, and advanced manufacturing. Much of this silver is never economically recovered once it is embedded into products and systems. Over time, it simply disappears from accessible inventories. For decades, this characteristic was offset by above-ground stockpiles and by the assumption that silver was abundant enough to meet both industrial and financial demand. That assumption was never based on unlimited supply, but on the absence of sustained financial absorption. As long as investment demand remained cyclical and opportunistic, the system remained balanced. ETFs change that balance by introducing persistent financial demand that operates independently of price signals. When capital flows into a physical silver ETF, the fund must source metal regardless of market conditions. The metal is not purchased for short-term use or resale. It is purchased to sit in custody for as long as investors maintain their exposure. This fundamentally alters the flow of silver through the market. At $10 billion in size, BlackRock's silver ETF represents a meaningful share of the accessible physical market. Annual global silver mine production, when measured in dollar terms, is relatively small compared to institutional capital pools. In some years, the total value of newly mined silver barely exceeds a few tens of billions of dollars at prevailing prices. When a single financial vehicle absorbs a large fraction of that value, the system's flexibility begins to disappear. The supply side of the silver market compounds this rigidity. Silver is rarely mined as a primary target. Most global production comes as a byproduct of copper, lead, zinc, and gold mining. As a result, silver output is driven by the economics of other metals, rather than by silver demand itself. Even significant price increases do not lead to rapid expansions in supply, because producers cannot easily adjust output without altering entire mining operations focused on different commodities. This creates a market where supply responds slowly, while demand can scale quickly. Industrial consumers require silver to maintain production and cannot easily substitute it without sacrificing performance or efficiency. Financial investors, through ETFs, can add demand almost instantly by reallocating capital. When these two forces intersect, the result is not equilibrium, but tension. BlackRock's role in this process is significant not because of intent, but because of position. As the world's largest asset manager, BlackRock's products are embedded deep within the architecture of global finance. Its ETFs are held by pension funds, retirement accounts, institutional portfolios, and automated allocation strategies. These are not tactical trades designed to capture short-term price movements. They are structural positions designed to provide long-term exposure. This distinction changes how silver is held and for how long. Metal acquired by an ETF is not actively recycled through the market. It remains immobilized until investors collectively reduce exposure, which often occurs only during broad portfolio reallocations rather than commodity-specific events. As ETF ownership grows, a larger share of above-ground silver becomes effectively locked away. At the same time, price discovery continues to take place primarily in futures markets dominated by leveraged contracts that settle financially rather than physically. This creates a growing disconnect between quoted prices and physical accessibility. The market may appear liquid on screens, while actual availability tightens quietly in the background. Under stable conditions, this disconnect can persist without obvious stress. During periods of disruption, however, it becomes visible very quickly. Industrial buyers move to secure supply, inventories are drawn down, and premiums emerge. Because supply cannot respond symmetrically, even modest increases in physical demand can produce disproportionate effects. Historically, silver has exhibited this kind of nonlinear behavior. Small imbalances between supply and demand have often led to sharp price movements, not because silver is rare in absolute terms, but because the margin between available inventory and required consumption is thin. What distinguishes the current environment is that the pressure is no longer speculative or temporary. It is institutional and persistent. BlackRock does not need silver prices to rise for its ETF to function. The fund succeeds simply by providing exposure. Yet the act of providing that exposure has consequences for the underlying market. As the ETF grows, it absorbs metal, reduces float, and increases the system's sensitivity to shocks. This occurs regardless of whether prices move up or down in the short term. $10 billion is therefore not just a number. It is a signal that silver has crossed into a different phase of market structure. Once an asset becomes integrated into institutional allocation frameworks, it attracts additional capital over time. Index methodologies evolve, portfolio models adjust, and competing products emerge. Each step appears incremental, but the cumulative effect is substantial. This is how markets change without dramatic headlines. The shift does not announce itself through sudden crises, but through tightening conditions and altered behavior. Analysts searching for narratives often miss the underlying mechanics. The critical variable is not sentiment, but ownership. Silver is transitioning from a market dominated by users and traders to one increasingly influenced by long-term allocators. As ownership shifts from circulation to custody, the market's behavior changes accordingly. Liquidity becomes conditional, volatility becomes structural, traditional assumptions about supply responsiveness and market depth become unreliable. This does not imply a specific outcome or timeline. It does not guarantee higher prices or systemic failure. What it does guarantee is that the silver market will no longer behave as it once did. The constraints that were once hidden are now active. BlackRock did not create those constraints. They existed long before institutional capital arrived. What the ETF has done is expose them by operating at a scale the market was never designed to accommodate. Once exposed, those constraints do not disappear. They shape the system going forward. In that sense, the significance of BlackRock's silver ETF is not measured by daily price movements, but by the quiet reconfiguration of a century-old commodity market. The change is gradual in appearance, but profound in implication. And by the time it becomes obvious, it is already embedded in the structure of the system.